Here's what the skeptics think about Bitcoin. After a catastrophic collapse that saw it drop as much as 83% since the start of 2017, it's come roaring back to trade at record highs. It's nothing more than a collection of zeros and ones stored on computer hard drives, yet people are now regularly paying more than $50,000 for one of these artificially scarce digital assets. But not everybody's convinced it's a good idea, and there are still a fair few people out there who call it a scam, a Ponzi scheme, or just plain and simple a waste of good energy. But let's start with the believers. Created in the wreckage of the 2008 global financial crisis, Bitcoin was a response to ultra-loose monetary policy and the central banks printing money. Its mysterious creator, who went by the name of Satoshi Nakamoto, wanted to create a digital version of gold. The aim was to create an asset backed by cryptography that would eventually become a hard currency that could supplant the dollar. In doing so, Satoshi solved an age-old computer science paradox, one called the two generals problem. The basic idea of this paradox was it was almost impossible for two parties who didn't trust one another to transact without an intermediary that both parties have complete faith in. Enter the blockchain, a public ledger that records every transaction ever made with Bitcoin and can only be changed if a majority of ledger writers agree. At the same time, it requires proof of work, a concept that means energy was expended to create new Bitcoin. And the genius of the idea doesn't end there. The real masterstroke was in defining in the original Bitcoin code and the white paper that acted as the statement of intent that there would be a cap on supply, created at a diminishing rate until created algorithmically by a process described as mining, but which involves thousands of computers solving mathematical problems. The last Bitcoin is minted in about 2140. So who are the people getting in on Bitcoin? In the early days, Bitcoin investors were a motley crew of computer nerds, gold bugs, and hard money adherents. The first transaction for real-world goods took place in 2010 when programmer Laszlo Hanyek paid 10,000 Bitcoin for two large Papa John's pizzas. Today, though, droves of investors are in on it. By the end of last year, there were more than 63 million wallet addresses. The one investor can have many addresses or none. We've seen retail and institutional money flowing into the space. Even Elon Musk caught the fever. So who doesn't like it? Loads of people, and from all walks of life. First, from the sphere of computer science, there's Bill Gates. He's publicly joked that unless you're the richest person in the world, it's probably not a good idea for you to get in. Then, in the investment sphere, JP Morgan CEO Jamie Dimon at various points in the last few years said it was not his cup of tea, a terrible store of value, and at one point a fraud, though he later walked back the last comment. And finally, there's regulators, some of whom have kept it at arm's length, waiting to see how it develops, while others have warned that those buying it could lose all their money. So what are the charges against Bitcoin? Well, Bitcoin failed in its original goal of displacing the dollar. Few people use it to transact because it's simply too volatile. Instead, it's become a purely speculative asset. People buy it hoping that other people will buy it from them at a higher price. That's called the greater fool theory of investing. And like a Ponzi scheme, it requires a constant stream of new money coming in to make it increase in value. When that stream stops, the critics warn the whole thing might collapse. At the same time, all those computers mining new Bitcoin and scribbling the blockchain require vast amounts of electricity. The network probably consumes as much energy as the country of Argentina, and its thirst just keeps on growing. Perhaps the hardest criticism to dismiss is that Bitcoin is hard to scale up and inefficient. Visa might clear 1,700 transactions per second, Bitcoin 5. And generally, the dystopian vision of a trustless world is unfounded. It's almost always cheaper to adopt a central counterparty whose job and profit comes from the trust placed in it. One such example is a clearinghouse at a stock exchange who stands between parties, making sure no one loses money if the other side of the trade defaults. In short, there are better ways to solve problems Bitcoin is trying to solve. I'm Eddie van der Walt. For more on the world of cryptocurrencies, follow us on QuickTake and Bloomberg.